Topic 4, basic accounting concepts. We are going to continue from where we left off with the balance sheet. So we're going to start off with a very quick review of the income statement, the profitability of a company over a period of time. And these are temporary accounts. Remember, they always start at 0 at the beginning of a new fiscal year. They accumulate over 12 months. At the end of the 12 months, we close them out, and the difference between sales revenue, costs, and expenses, hopefully it's a profit, moves into retained earnings on the balance sheet. That goes into the equity section, a very important plug to make the balance sheet balance. So we're going to quickly go over the income statement. Then the last statement, those temporary accounts, they start when you set up a business. They go up and down forever. They are permanent. We always hopefully have some cash in the cash account and the other asset, liability, and equity accounts. And it is a snapshot on one day of the financial health of a company. What do you own? According to accounting, your assets, what do you owe to other people you're going to have to pay out either in the next year or in future years, and the difference, shareholders, stockholders, equity, if it's a public company. All right, so the beginning statement's the income statement, the ending statement's the balance sheet. In between is what we're going to talk about today. The statement of retained earnings, or the statement of equity, we show the retained earnings. We'll see how this works. Cash is king. So we go from accrual-based accounting back to real cash flow. Boy, this is the one that's so important in business. Generating cash flow is what a business is all about. And how do we value a business? We look at their future cash flows and usually bring them back to present value to see what the value of a company is against their market capitalization. That's one way to value a company. And I like to look at a company's cash flow from operations. How much true cash are they generating from their businesses? How does that compare to their accrual profit? Would like for their cash flow to be more if they're keeping their working capital accounts under control. That's their accounts receivable, their inventory, their accounts payable. Very important accounts to keep under control. All right, we will see how you bring these together in the whole picture. Really, to understand a business, you can't look at any of the individual pieces. I mean, the pieces are important, but the way the pieces fit together, it's like a jigsaw puzzle. You can look at the pieces of a jigsaw puzzle and you know a little bit about the big picture, but when you put them together, you can see the big picture. And that's what we'll do as we tie the key financial statements together to really understand a business. All right, so here are the 4 key financial statements. The income statement, profitability of a company over a period of time. The ending statement, the financial health of a business on one day. What do you own? What do you owe? What's the difference? And the profits that have been put back in the business over a period of time. You can see this in the statement of equity. This is just a metric, just a number. It's not a wad of cash sitting there. But this is a very important metric of profits put back in since the business started. It's a cumulative. If there's ever a loss, it subtracts from this number. And last, cash flow. King. What cash flow comes in? What cash goes out? What cash is left at the end of a fiscal period? And this plugs into the top of the assets of the balance sheet. So you got 2 key plugs. You got the cash flow plug, the liquidity of a company, and you've got the retained earnings, the profits have been put back in. So we're going to see how this works. All right, we learned from the last video that the income statement always starts with selling a product or service. and we look at our net sales after returns, discounts, and allowances. Quantity times price of our products or services and what we expect to get paid from our customers. Revenue or sales. Net means after returns, discounts, or allowances. This is the sales we expect to collect from our customers. And some of this might be sitting in accounts receivable if it hasn't been collected yet. We match in accrual-based accounting. All public companies use accrual-based accounting. They match the cost either to make their product or service or to buy something they're going to sell to their customers. We call it the cost of goods sold if you're a manufacturing company, or the cost of sales if you're like a retailer that buys something from vendors and suppliers and resells it. Somebody like a Walmart, a Target, a Costco. Those companies buy a lot of things from other people, and we're looking at the real cost they pay to buy it against what they sell it for. And the difference is a very important number called gross profit. That's in dollars. And gross means before we take off our operating expenses. So right now we've just taken off cost. And the gross margin, a percentage, takes the gross profit and divides it by the net revenue or sales. That's a very important percentage. We want to maintain or improve that. How can we do it? Charge more for our products or services, keep our costs down. All companies are working on this. Efficiencies, productivities, negotiating with vendors and suppliers. And it has a lot to do with your industry on how you can do this. But certain industries have higher gross margins than others. Somebody like a mass retailer, they might be close to their competitors on gross margin, but it costs them a lot to buy things or make things. Operating expenses. Well, one of them is a non-cash operating expense. We learned about capitalizing versus expensing in the last video. Well, if we bought something, a piece of equipment, a building, a truck, and we capitalize it, we put it on the balance sheet at what we paid, historic cost, and as it gets older, we're bringing it down and taking that expense on the income statement. But it's called a non-cash expense. Why? Because we're not writing a check for it now. We spent the money when we bought it. Now, depreciation is for hard, tangible assets. Amortization is the same thing, but it's for intangibles. Maybe it's for software, patents, copyrights, trademarks, those type of things. So these things are taken off, but we don't spend them. We have a lot of SG&A, selling, general, administrative. This is a catch-all for like finance expense, marketing expense, advertising expense, IT expense, on and on and on. Lots of operating expenses to run your business. And this could be monthly, quarterly, or yearly if we're looking at what period of time on the income statement. If you're a company that does R&D, it's required under GAAP that you expense research and development. You must take it off as an operating expense. So we take off now all of these operating expenses for the period we're looking at, and this is a very important line item. Operating profit, also known as EBIT, earnings before we take off interest expense and tax expense. This margin is called your operating margin. A lot of the companies I work with, they might say we need a 15% operating margin. For every dollar you sell, you can spend 85 cents on cost and expenses, but we want 15 cents or 15% left to cover the other things. The other things are like interest expense. That's the I of EBIT. And that's a legal deduction before you pay taxes. So if a company goes out and takes on long-term debt and pays the banks an interest expense, you can take it off on the next line. If you are a company that's not a bank and you take some of your free cash and invest it, you might make some investment income. That's not your regular product or services, so you don't take that up above, you take it below operating profit. So here we'll look at the other things. Other operating income or interest income and the interest expense to service our debt. That's a deduction, a legal deduction before taxes. So now we take the pluses from other income, the minus from interest expense, or any other thing that's non-reoccurring. It's kind of a one-time thing, maybe a closing operation or something like that. That's other. You have your profit before you pay taxes to the IRS. We set up a provision for taxes at your corporate tax rate. It might be in the low 20s right now. So now we have to take off the income taxes and get to the bottom line. Very important number, the bottom line. That's your net profit, your net income, your net earnings. So the top line we can call sales revenue. The bottom line we can call profit, income, or earnings. Some companies call it an income statement and look at your net income. Others call it a statement of earnings and call it their net earnings. The net margin takes the bottom line, divides it by the top line. For every dollar you sell, what's left over after all cost and expenses, all the red items? All right, how do we figure EBITDA? You hear about EBITDA. A number it's closer to cash flow. It's not exactly cash flow, but it's closer. It's not a GAAP number, but it's such an important number in today's world. A lot of CFOs, CEOs look at their EBITDA. So how do we figure it? We take that EBIT and we add back what we have taken off but didn't spend. Remember, we didn't spend that D&A. That's only an accounting transaction we take off. Since we didn't spend it, we have it, and we added back. EBIT plus the depreciation and amortization equals EBITDA. A lot of companies look at their EBITDA. Top line, bottom line. Profitability of a company over a period of time in accrual-based accounting. Very important financial statement, and this is the one we always start with when we do our financials. Financial statements are done in a sequential order, and it always starts with the income statement. Now, we know it ends with the balance sheet, but before we move on, let's look at an actual income statement. We'll look at Microsoft for their fiscal year ending in June 30th. That's the last day of their fiscal year, and they have to give us 3 years. 2019, 2020, 2021. And why do they have to give it? We want to see the trend in these numbers over a period of time. So GAAP requires them to show us 3 years. So we're going to work our way down here on the income statement. Now we know the top line, revenue, we've talked about that, total revenue. Well, there you can see it's gone from 125.8 billion to 143 billion to 168 billion. That's a nice trend. Now they break it down into sales or revenue, and this is revenue from products and revenue from services and other. And we can see the trend there. You can see that service revenue has really picked up for Microsoft, and that is very profitable revenue. So that's what we like to look at. Remember, we match to this number cost. So we got 168 billion plus in revenue. What was the cost for the products and services to generate that revenue in our accrual? So we can see there was 18 plus billion for product cost and 34 billion for service and other cost. That adds up to total cost of revenue of 52.2 billion. We take that off at 168 billion and we have our gross profit, and they call it gross margin, of 115.8 billion. Now we can see the trend over 3 years for that very important number. Below that is the operating expenses we just talked about. R&D, they must expense that. Sales and marketing, general and administrative. So you've got 3 key line items of operating expenses over 12 months. 20.7 in R&D, 20.1 in sales and marketing, and 5.1 in general and administrative to run your business. So now we're going to take all of those off of the 115.8 and get that EBIT, operating income, of 69.9, almost 70 billion. Now they had some other income, and that's net after some things, but they actually have another 1.1 billion or 1.2 billion of other income from investments and other things. If you really want to know what makes up that number, you got to go to the footnotes. The devil is in the details, and we say the details are in the notes or footnotes behind the financials. So we could find out about that number. We add that to the 69.9, we come up with 71.1 billion, and that's income they have to pay taxes on. And their provision for income taxes is 9.8 billion, bringing us down to net income of 61.2 or 3. Now, what's their tax rate? Well, I figured it there. You take 9.8 billion, you divide it by the income before income taxes is 71.1, and they're paying about 13.8% of their income before income taxes out to the IRS. That's the provision they think they're going to have to pay out. That's better than the normal corporate tax rate at 20. How can they get it down? Well, there might be some loss carry forwards or accelerated depreciation, very sharp tax accountants that legally take all the legal tax loopholes. And they do that. All right, so we're down to the bottom line of 61.2 or 3 billion. Now that's called our return. Return on sales of 168 billion. But remember, that's an accrual number. That's not cash. And that number is going to go into our other financial statements, as we're going to see. So remember these key numbers. Our gross margin for Microsoft, if you look at their sales, you look at their gross profit or margin, was almost 69%. For every dollar they sold, they've got 69 cents left after cost. That's an excellent gross margin. So we watch this from year to year and always want to maintain or improve our gross margin. Their operating margin was 41.6 or rounded up 42%. Excellent operating margin. I said some of my companies I work with would like to have an operating margin of 15%. Well, look at that. They just blew it away last year. Their net margin is 36.5. Incredible. Wonderful margins. Great numbers for this year. And these things affect the stock price. Yes, a great company that's thinking about the future. And right now they are thinking about spending a lot of money buying Activision. They think this metaverse and how are they going to continue these numbers in the future? The economy of scale, and as you get bigger and bigger, it gets harder and harder. So strategic planning right now, they're thinking about spending a lot of money on Activision to kind of keep these numbers going this way in the future. Time will tell. All right. Back to the balance sheet, the last statement. Now, here they're required to give us 2 years, 2020 and 2021. So on the last day of the fiscal year, June 30th, we stop, take a picture of the business, a snapshot on one day, and on this day, what do they own? Well, let's look at the top assets. We own current assets of $184 billion. Those are considered somewhat liquid assets. In fact, if you look up above total cash, cash equivalents, and short-term investments, $130 billion of that 184 is really liquid. They could turn that into cash very quickly, 3 months or less. Now, those other things are a little harder, but accounts receivable, they hope to collect in the next 12 months. Inventories, if they had to, they think they could sell them and turn them into cash quickly. And then they've got some other current assets. Now, if we want to know what that other current is, we'd have to look in the footnotes once again. But total current, $184 billion. Incredible. Now, there are long-term assets, property and equipment, that has taken off that accumulated depreciation. They've got some operating lease. They've got some equity investments, some goodwill. We'll get into these line items as we move forward into our financial training. Intangible assets, that's a big one for them because that's a lot of software. The goodwill is usually companies they have purchased and paid more for than the book value. The intangible assets, a lot of that 7.8 would be software. And then they got some other long-term assets. All right, so we've got our tangible assets. We have, basically capitalized, and we've got our intangible assets. We basically have set up on the books, and we'll amortize some of those as they get older. But total assets, according to accounting, $133 billion, 800 million rounded up. Incredible. Incredible company with a AAA credit rating. So this is the asset side of the balance sheet. Next, we'll look at how did they get all these resources and the values only according to accounting, not the market value. All right. They are going to have some liabilities too. So we next look at the liabilities. They have some current liabilities. Things are going to have to pay out in the next 12 months. Those current liabilities add up to $88.6 billion. That's going to have to be paid out. So we always like to look at what's coming in, current assets to current liabilities. And they got a very good current ratio. We're going to get into the ratios next as we move forward into topic 5. We'll see how we do this. We'll do this for Microsoft and other companies. Compare them against some of their competitors. Now, some of their long-term liabilities, like long-term debt, $50 billion. That's what the borrowed from the banks are paying interest on. They got some long-term income taxes. Now, long-term unearned revenue. That's an interesting number. That's like money they've received they haven't given anything for yet, so they set up a reserve. The example for some companies might be like for gift cards. You pay for a gift card, but they haven't given anything for the gift card yet. Here they've gotten some deposits in they haven't given anything for yet. Maybe they got money in for software which you're leasing from them over a period of time and the period hasn't passed. Some deferred income taxes, other operating lease liabilities, other long-term liabilities. Once again, you want to know about those numbers, look in the notes. Total liabilities, $191.8 billion. They got a lot of liabilities. The difference between assets and liabilities, remember, is equity. It's got to balance. That's why we call it a balance sheet. Now, these are some of the numbers we're going to get into next under the equity. Remember, when you sell stock, you do an IPO that brings in money. The cash goes up, the equity goes up, called common stock, or it could be preferred, but in this case it's common, in the equity section of balance sheet. Retained earnings, remember, are profits put back in since they started. I love to see this. Their retained earnings have gone up from 34.6 to 57 over the last 12 months. We're going to see that now. Remember this line item right here. Let's see. There it is. Retained earnings, that's the profits put back in. Now that accumulated other comprehensive income might be the changes in currency rates and investments for pension plans and other things, but that's a positive number. That's sometimes you see it as a negative, but in this instance, it's a positive. So the money brought in from the sale of stock, the profits that have been reinvested in the business since they started, and the accumulated other things from currency exchanges and other, and then that adds up to 141 or almost 142 billion. Plus the 191.8 in liabilities, it's the same as the assets. It's got to. Assets always equals liabilities plus equity on one day. Then we can see their current ratio, as I said, they got a lot more that could come in than go out in the next 12 months. Their debt to equity ratio looks pretty good too. Even though the liability is a little higher, still that's a good, strong balance sheet. Excellent balance sheet. All right, now how do we get these numbers in the balance sheet? We're going to go to the statement of equity and look at it next. Now, in the middle of the statement of equity is a section that looks at retained earnings. So that's what we're going to look at here, this middle section on retained earnings. All right. The way it works is we had a beginning balance in retained earnings of 34.5 or 6 billion. That's a metrics over the years, what was put back in at the beginning of the year. Now, if you remember this year in accrual accounting, Microsoft made a bottom line accrual profit of 61.3 billion. That adds to retained earnings. Then what we do is we take off, if we pay dividends to our shareholders, if we buy back our stock, and if there's some other things. And here we had a cumulative effect of some accounting changes. So off of that, we take off 16.8. That's what we paid out in cash to our shareholders. That takes off of retained earnings. They spent 21.8 or 9 billion buying back their own stock. And we'll get into that as we move forward. Why do we do that? To reduce the number of shares and help earnings per share. And we don't know what to do with that cash, so we think our stock might be a good value right now. You know, that's questionable with the way the stock market's gone, but they spent a lot of money. You can see the trend has gone from 15 to 18 to 21 or almost 22 and buying their own stock back. All right, so those are minuses to retained earnings. We do the math, and we still went from 34.5 up to 57 after we take those things off. And that's the plug that moves into the balance sheet to make it balance. Very important section of the balance sheet, the equity section. All right, so they have gone over the last 3 years from 24 billion in retained earnings. That's the ending in 2019. That's the beginning of 2020. Down to 34.5 or 6 at the end of 2020, up to the starting of 2021 of that 34.5 or 6. Now we're ending with 57. And those are the numbers we saw in the balance sheet in the equity section. All right, these are the plugs to make the balance sheet balance. And the other plug is cash, and that's what we're going to look at next. That cash flow statement. Now the total equity went from 118 up to 141 or 2. That's in the balance sheet. These pieces fit together as we're going to see. Once you understand the pieces and how they fit together, you really can understand the company from their numbers. These are the scorecards of a company. All right, the cash flow. What we're going to do next is we're going to convert accrual back to real cash flow. We adjust the accrual bottom line, net income, back to cash. We're going to see this. And then we break down in the indirect cash flow statement the cash into three very important categories. I like to say this first category is really the key number in business. Did a business generate operating cash flow? And how much is it? Is it more than accrual profit? That's a great thing. What did they use the operating cash flow on? A lot of companies use it investing. Investing means we're buying like capital expenditure investments to keep the business up to date, to grow it into the future, to buy other companies. Activision, if they buy Activision and it's approved by the regulators, they might spend 70 billion plus. That's going to be out of cash flow from investing. Mergers and acquisitions. Then we might bring in more cash from borrowing. That's financing. We might sell more stock, IPO, another IPO. That's cash in from financing. We might buy back our stock. That's using cash to buy back our own stock in financing. We might pay dividends. That's using cash under financing. We might pay the banks back part of the principal. That's using cash in financing. So we're really looking at cash in and out and the change in cash flow from operations, investing, and financing. So we do the sum of those things and we look at the plus or minus changes in cash during a period of time. And if it's for a fiscal year, it's for the past 12 months. What cash did we start with at the beginning of the fiscal period? What cash do we have at the end? And that's the number that's going to plug in to make the balance sheet balance. That plugs into the cash on the balance sheet, the most liquid top number in accrual-based accounting. So we're going to see how this works. All right. So if you remember from the income statement, the bottom line, their net income was 61 billion. There it is. That's accrual. That's an accrual number right there. That's not cash. So what do we do on the cash flow? We do the adjustments. We'll get into these adjustments as we move forward because they get a little complicated, but we look at the beginning numbers, the ending numbers, the change or delta, and how it affects cash, plus or minus. If it has brackets around it, it's a minus. If it doesn't, it's a plus. We always add back depreciation amortization as we learn because you took it off and you didn't spend it. So they have that 11.6 or 7 billion. So all of these are adjustments to come down to the real cash from operations. I love to see this. Microsoft actually generated 76.7 billion in real cash from operations. And that's more than 61. That's a great thing. This is a great company generating a lot of cash flow. We say they're a cash cow. Now what did they do with this 76.7? Well, we can see in the next groups on the cash flow, investing and financing. I think they show us financing next, yes. So they're showing us under financing, and these line items show what they did. Brackets, they used it. If it's not in brackets, they brought it in, and they used a lot of it. 48.5 rounded up was used in financing. The big one is common stock repurchases, 27. Common stock cash dividends paid, 16.5. And some other things, repayments of debt and other things. So we spent 48.5 billion rounded up. Under investing, they spent a lot too for additions to property and equipment. They bought 20.6 billion of CapEx. Acquisitions, mergers and acquisitions, another 8.9. Purchases of investments, this is interesting. They went out and bought a lot of stocks and bonds. 62 or 63 rounded up billion in investments. The maturities of investments, basically, cash out is buying, cash in was from their investments. The sales of investments brought in another 14 billion and just some other things. So there's another, with a 48 billion above was from financing. Here we got investing, we've got another 27.6 going out. We do the sum of the three numbers, and first of all, there's a little number for foreign exchange. That's the currency exchanges from all their global operations around the world. But the real change in cash is a positive 648 million during the year. Now, they started with 13.5 or 6. Where did we get that? From the previous year. Because you can see they were left with 13.6 in real cash in 2020. That moves to the beginning cash for 2021. And now we just generated another 648, giving us the bottom line of 14,224. You see that number at the top of the assets on the balance sheet. So the change in cash during the year, we generated 76.7 from our operations. We used 48.5 rounded up in financing. We used another 27.6 rounded up investing, 29 from basically foreign exchange rate changes, and there's the 648. That adds to the beginning cash, giving us the ending cash that goes to the balance sheet. There it is. They really had 14.2 billion in cash available on the basically day we did the balance sheet, the last day of the fiscal year. All right, so this is the cash to the balance sheet. The other thing we sometimes look at is free cash flow, and this is a simple way to look at it. We take the cash flow from operations minus CapEx, and you can see CapEx is addition to property and equipment, that's a 20.6, and also mergers and acquisitions for buying businesses, 8.9. The difference is like a 47 billion in free cash flow we can use for other things. That's another metric we watch. All right, let's bring it together and wrap this video up. There are three key financial statements in business. Here they are. It starts on the right with the income statement. Profitability of a company over a period of time. Temporary accounts that roll back to zero. So if we're going to start a new business, we need to have some resources. And how do we get resources or assets? Usually we go out and either borrow money or sell stock. So let's say the sources of capital or the sources of money or funds come from stock or debt. And remember, long-term debt we borrow from banks, we pay interest on. But that's a deduction before taxes. So now we raise some capital. That's the sources of capital. We've got to come up with some great products and services we can sell to our customer. That's the only reason we're in business. We've got to have a great product or service we can sell, hopefully for more than our costs and expenses. That's really the equation of the income statement. Sales revenue minus costs and expenses equals profit or loss. To generate sales, we got to have some assets, and that's the uses of our capital. So we'll invest in current, fixed, and other intangible assets. Property, plant, and equipment, software, patents, copyrights, other things, and current liquid assets. Now we probably need to hire some people. Microsoft has a lot of people around the world, and they got to pay the people. And they've got some other operating expenses. So you're going to have some costs and expenses to run your business. So what do we do at the end of a period? Could be a month, a quarter, a year. We list the sales during that period, match in accrual-based accounting the costs and expenses incurred to generate those sales and revenue. And hopefully, if we're a good company, this is the key, we charge more for our products and services than the costs and expenses and make a profit in accrual. Now, what can we do with those profits? Well, we can either put them back in the business, which is a great thing to do, or pay part of them out in dividends to shareholders if we get steady, consistent cash flow. Growth companies, they don't pay a dividend. A lot of the technology companies or new startup companies don't pay dividends. But as you're a mature company with good cash flow, you might start paying part of the net profits out in dividends, which Microsoft does. So they're going to put part of it back in the business. This is called their payout ratio, what they put back in and what they pay out. So dividends, if paid, reduce the profits before going back into retained earnings. So they're going to put part of it back in the business. That adds to the retained earnings, and they'll pay part of it out to the shareholders in dividends. Okay? If you'd ever have a loss, which can happen, it'll reduce what goes back in the business. All right. Now, we're going to move the net profits, that's an accrual number, over to the top of the cash flow statement and do those adjustments coming to that very important number, cash flow from operations. That was like 76 billion if I remember right. Then we can spend it on investing or on financing, do the differences. And remember, that goes into the balance sheet as liquid cash. So the ending cash goes back into the assets, and you can see that is a plug to make the balance sheet balance. The other plug is the retained earnings. To understand a business, you've got to look at all three of these financial statements. Right side, in accrual, profitability of a company over a period of time. What cash was actually generated during the period of time we're looking at. And last statement is the financial health on one day. What do we own? Our total assets. What do we owe? Our total liabilities. The difference, our equity. That's the part of the assets the shareholders own. As we move forward, we'll look at the ratios to analyze these statements and see how a company's doing. And it's a great way to compare one company to another company. All right, see you soon as we move into topic 5 and move forward.